All right, let's get right into it. Today, we are tackling a massive paradox that's playing out across the financial world. I mean, on one hand, you've got trade wars simmering, global tensions are high, and there's a ton of economic uncertainty. But on the other hand, the stock market is acting like the party's never going to end. So, how can both of these things be true at the same time? Let's unpack this.
So this is the big puzzle we're going to try and solve today. It just doesn't seem to make any sense, right? How can stocks be absolutely shattering records when you look at the headlines and they're just full of risk? It feels like we're living in two completely different realities at once, and we're going to figure out why.
Okay, so first things first, let's be super clear. This isn't just some small rally. The market is in seriously bullish territory, and the numbers absolutely prove it.
I mean, just last week, all the major U.S. indices, the Dow, the S&P 500, the Nasdaq, they all pushed into completely uncharted territory. We saw the Dow up over 1.5%, the S&P 500 gained nearly a full point. The momentum is real, it's broad, and it is happening right now. But where is all this money actually going? The answer to that question reveals a really critical vulnerability.
Now, this is where it gets really interesting. According to Bank of America's latest report, the single most crowded trade, by a mile, is Long Magnificent 7. That's just a fancy way of saying everyone is betting on the biggest tech stocks. A staggering 45% of fund managers are piled into this one trade. At the same time, you see bets against the dollar or on safe havens like gold, they've shrunk. This tells us the market's good mood is incredibly concentrated in just a tiny handful of giant companies.
So, what's the actual fuel in the engine pushing everything higher? Well, it turns out there are some incredibly powerful mechanical forces at play here that have a lot less to do with the daily headlines and a lot more to do with cold, hard cash.
Just take a look at this number. Let that sink in for a second. That's the amount U.S. corporations have announced in stock buybacks just this year. That is a record for this time of year, going all the way back to 1982. Now, when a company buys back its own stock, it just reduces the number of shares out there, which mechanically pushes the price of all the remaining ones up. It's like a massive built-in support system for the entire market.
And this just brilliantly illustrates the other side of the coin, earnings. So many people look at tech valuations and think we're in some kind of bubble. But let's just take NVIDIA as an example. 2 years ago, its price-to-earnings ratio was a sky-high 158. Today, even after its stock has gone on this massive run, that ratio is actually down to 54. So why is that? It's because its profits have grown so incredibly fast that the valuation is, believe it or not, looking more reasonable. These tech giants are genuinely earning a ton of money.
And here's the paradox within the paradox. This is wild. An unbelievable 91% of fund managers think the market is overvalued, and yet they keep buying? So why would they do that? Well, it's because there's a flood of money coming from regular investors into things like ETFs, and those managers, they have to put that cash to work. Investors' stock allocation is the highest it's been since 2007, and a key measure of fear, corporate bond spreads, is at its lowest point since 1998. So they feel like the market is expensive, but they're being mechanically forced to stay in the game.
But, all these market mechanics, that's only half the story. The other half is being driven from Washington, where a really high-stakes geopolitical chess match is unfolding right now. Sources suggest the administration's #1 goal in this big diplomatic push with Russia and Ukraine isn't just about peace for its own sake. It is, at its core, an economic strategy. The main objective is to end the war in order to unleash a global energy surplus, because more supply means lower oil and gas prices for everyone, everywhere. And this is the crucial chain reaction, the domino effect that the market is betting on. A peace deal leads to a drop in energy prices. Falling energy prices are the fastest way to pull down overall inflation. And if inflation is finally under control, well, that gives the Federal Reserve the green light it's been waiting for to start cutting interest rates, which, as we all know, is the ultimate rocket fuel for a stock market rally.
But, okay, can a deal actually happen? This table kind of breaks down the major sticking points. You look at territory. While Putin wants formal annexation and Zelensky rightly rejects ceding any sovereignty, this idea of conceding administrative control creates a potential, albeit very narrow, sliver of compromise. And on NATO, while the official positions are miles apart, you see Ukraine's expectations have lowered a bit, which could open the door for some kind of guarantees instead of full membership.
Look, the gaps are huge, but the market seems to be pricing in the possibility that these narrow paths could actually lead to a deal.
Okay, but let's just say this whole geopolitical strategy works out and energy inflation is solved. Does that mean we're in the clear? Well, not exactly. A completely new inflation threat is starting to brew, this time from a totally different source.
If you look at what's actually driving inflation right now, it's not energy or even physical goods. It's sticky services. Things like car repairs are up 12%. Hospital services are up 6%. These are labor-heavy costs that don't go down easily. Meanwhile, prices for goods, like smartphones, they're actually falling, down a massive 15%. This shows the current battle against inflation is a very, very different one.
And this sets up the next major conflict. What happens if the administration solves energy inflation through diplomacy, only to create a whole new wave of goods inflation with trade tariffs? It's a tug of war. You might get some relief at the gas pump, but then the price of furniture, electronics, and cars could shoot right back up. This is the next economic battleground the market is trying to get ahead of.
So, with all of these conflicting forces, you've got mechanical buying, geopolitical chess, dueling inflation threats. How can we possibly make sense of it all? The answer, I think, lies in understanding that the market isn't a simple machine. It's a game of psychology where everybody is trying to guess everybody else's next move.
Let me start with the punchline of a great little story that explains this perfectly. A monkey comes down from a tree, slaps a young man right across the face, and says, "You think only you have a grandfather? Now let me tell you how we got there."
So the story is pretty simple. A hat seller's hats are stolen by a bunch of monkeys up in a tree. He gets frustrated, throws his own hat on the ground, and the monkeys, being monkeys, copy him and throw all the hats down. He gets his hats back. Fast forward 40 years, his grandson is in the exact same spot, remembers the story his grandfather told him, and tries the exact same trick, but this time it doesn't work. A monkey comes down, slaps him, and says that line.
The whole point is that the monkeys had a grandfather too. They learned from the past. The game had changed, and that is exactly what happens in the market. It's a multi-level game. You know something, but the market knows that you know it. The Fed knows what the administration wants. The administration is trying to anticipate the Fed's reaction. History rhymes, sure, but it never repeats exactly because all the players learn, they adapt, and they try to outthink each other.
And that leaves us with the final question, doesn't it? In this incredibly complex game, where corporate buybacks, diplomatic maneuvers, and investor psychology are all tangled together, the most important thing to ask isn't just what will happen next. It's who is anticipating whose next move. And thinking about that, I think, is the real key to understanding the paradox of this bull market.